This is the story of how artificial intelligence became the most overhyped and potentially overvalued technology in human history. 3 years is all it took to create the world's first $5 trillion company, generate 75 to 80% of all United States stock market gains, and convince investors to pour hundreds of billions into companies that lose money on every single customer they serve. The question on everyone's mind comes down to one thing: does this represent a technological revolution or the biggest financial bubble since the dot-com crash? And here's why this matters to you personally. Stocks related to artificial intelligence now account for roughly 80% of United States stock market gains since ChatGPT launched. That means if you have a retirement account, a pension, or any investments tied to the broader market, you carry exposure to whatever happens next. A Bank of America survey found that 54% of fund managers already believe artificial intelligence stocks have entered bubble territory. What follows breaks down exactly what is happening, who is sounding the alarm, and why the next 18 months could determine whether this becomes the greatest investment opportunity of our lifetimes or the biggest trap. Understanding where we stand requires understanding how fast this happened. On November 30th, 2022, OpenAI released ChatGPT. Sam Altman announced it on Twitter without any fanfare. 1 million users signed up within 5 days. 2 months later, that number hit 100 million, faster than any consumer application in history. For comparison, TikTok needed 9 months to reach that milestone, while Instagram took 2.5 years. Silicon Valley's response came as immediate panic. Google executives issued an internal code red alert, and co-founders Larry Page and Sergey Brin, who had stepped back from day-to-day operations, returned for emergency meetings because they feared ChatGPT could threaten Google Search's core business. The money followed almost immediately. Microsoft committed $10 billion to OpenAI in January 2023, and Nvidia, the company making the chips that power AI systems, became the first semiconductor company to reach $1 trillion in market cap by May 2023. Goldman Sachs called it the most important stock on planet Earth. October 2025 brought another milestone when Nvidia became the first company in history to reach $5 trillion in market value, a number larger than the gross domestic product of every country on Earth except the United States and China. OpenAI's valuation climbed from around $20 billion in 2023 to $500 billion by late 2025, and their $40 billion funding round in March 2025 set the record for the largest private fundraise in history. These numbers represent something beyond normal growth, a complete transformation of financial markets in under 3 years. And this is where things get uncomfortable. OpenAI, the company sitting at the center of this revolution, hemorrhages money at a staggering rate. Revenue in 2024 came in around $3.7 billion, but losses hit roughly $5 billion. That means they spend approximately $2.25 for every dollar that comes in. The situation gets worse. Sam Altman admitted in January 2025 that this was an insane thing. He said they were currently losing money on OpenAI Pro subscriptions because people use the service much more than expected. Consider what that means for a moment. They charge $200 a month for their premium tier, and they still lose money on each subscriber. OpenAI's problems extend across the industry. Anthropic, the company behind Claude, reportedly lost over $5 billion in 2024, and Elon Musk's xAI burns through $1 billion per month. Which brings us to what might stand as the most significant analysis of the AI bubble, a calculation by David Kahn, a partner at Sequoia Capital, one of the most respected venture capital firms in the world. Kahn examined how much money flows into AI infrastructure, the data centers, the chips, the computing power, and asked one simple question about how much revenue AI companies need to generate to justify this spending. His answer landed at $600 billion per year. That number represents the gap, the revenue the AI industry needs to produce to make the math work, and right now they sit nowhere close. The warnings aren't coming from random critics on the internet, they are coming from inside the industry itself. Jim Covello, the head of global equity research at Goldman Sachs, published a report in July 2024 that posed a devastating question about what trillion-dollar problem AI will actually solve. His words cut deep. Replacing low-wage jobs with tremendously costly technology is basically the polar opposite of the prior technology transitions I have witnessed in my 30 years of closely following the tech industry. Goldman Sachs ran their own internal test by building a service that used AI to update analysts' spreadsheets, and the results told an uncomfortable story. The AI saved 20 minutes per company analyzed, but here's the thing. It costs 6 times as much as just having humans do the work. Covello's prediction carries weight. He says that if important use cases do not emerge in the next 18 months, meaning by early 2026, investor enthusiasm may begin to fade. Gary Marcus, a professor emeritus at NYU and former head of Uber's AI lab, put it even more bluntly in August 2025 when he declared that we are off the cliff, that this does not make sense, that nearly 500 AI unicorns valued at $2.7 trillion just does not match how much revenue actually comes in. His prediction states the bubble will burst, likely within the next few months. The most telling warning came from Sam Altman himself. OpenAI's CEO publicly acknowledged in August 2025 that he believes an AI bubble exists and that investors have become overexcited, warning that people will overinvest and lose money. When the person running the most valuable AI company tells you people will lose money, that deserves attention. Executive warnings tell only part of the story, so looking at actual results from businesses spending billions on AI matters more. An MIT study from August 2025 found that 95% of organizations investing in generative AI receive zero return on their investment. Zero. Despite $30 to $40 billion in enterprise spending. Another survey from Atlassian found that 96% of businesses have not seen dramatic improvements in organizational efficiency, innovation, or work quality from AI. Darren Acemoglu, who won the Nobel Prize in Economics in 2024, projected that AI will only boost United States productivity by about 0.5% and gross domestic product by roughly 1% over the next 10 years. He estimated that only 4.6% of tasks will actually face automation by AI. These numbers carry weight because the entire AI investment thesis depends on AI transforming productivity, and if massive efficiency gains don't materialize, the valuations collapse. The historical comparison becomes impossible to ignore at this point. On March 10, 2000, the dot-com bubble reached its peak, and over the next 2.5 years, the Nasdaq fell 76.8%. Investor losses hit an estimated $5 trillion, and the Nasdaq did not recover to its March 2000 levels until April 2015, 15 years later. Pierre-Olivier Gourinchas, the IMF chief economist, drew direct parallels in October 2025 when he said that many similarities exist between the late 1990s internet stock bubble and the current AI boom, with both eras pushing stock valuations and capital gains wealth to new heights. Torsten Slok, the chief economist at Apollo Global Management, went further by noting that the top 10 companies in the S&P 500 today carry higher overvaluation than they did in the 1990s. The current Shiller-Cape ratio, a measure of market valuation, sits around 40, which represents the third highest reading in 154 years of market history. The dot-com peak hit 44. A repeat of history would bring severe consequences. Former IMF chief economist Geeta Gopinath calculated that a dot-com magnitude correction could wipe out $20 trillion in wealth for American households, equal to 70% of United States gross domestic product. To present the full picture, smart people disagree with the bubble thesis. Howard Marks of Oaktree Capital stated in October 2025 that the valuations are not crazy, high but not crazy, and that he does not detect that level of mania at this time. Larry Fink, the chief executive officer of BlackRock, said he does not believe this represents a bubble, but rather capital that will in most cases prove well spent. Their argument centers on one difference from the dot-com era: profitability. Companies during the dot-com bubble burned cash with no path to profits, but today's AI leaders operate differently. Nvidia posted $31.9 billion in net income in a single quarter. Microsoft, Google, and Meta all generate strong profits. The tech sector's forward price-to-earnings ratio sits around 30 compared to 55 during the dot-com peak, and at the height of that bubble, Cisco traded at over 100 times earnings. Adoption rates support the bull case as well. 78% of organizations now use AI in at least one business function, over 54% of US adults use generative AI, and ChatGPT counts 800 million weekly active users. Productivity gains show up in specific use cases. One study found AI users completed tasks 25% faster with 40% higher quality, and customer support agents experienced a 35% productivity increase. Jensen Huang, Nvidia's chief executive officer, addressed the bubble talk in November 2025 by saying that from their vantage point, they see something very different, with Blackwell sales off the charts and cloud GPUs sold out. The honest answer about where this leaves us comes down to uncertainty. But certain facts remain clear. Extreme concentration defines the AI market right now. The Magnificent Seven tech stocks account for 37% of the entire S&P 500, a record level. That means if AI stocks correct significantly, the broader market follows. The next 18 months matter more than anything else. They represent the window Goldman Sachs identified for AI to prove its value. Transformative use cases that do not emerge by early 2026 could shift the entire narrative. One piece of good news exists for those worried about systemic collapse. This bubble, if it pops, probably will not cause a financial crisis like 2008. Most AI investment flows through retained earnings and corporate cash rather than debt. The IMF chief economist acknowledged that if a market correction comes, shareholders may lose out, but a banking collapse will not follow. Jamie Dimon, the chief executive officer of JP Morgan, captured the situation best in October 2025, when he said that AI represents something real, but there is a higher chance of a meaningful stock drop, and some money invested now will end up wasted. The bottom line comes down to this. We are living through either the greatest technological revolution since the internet, or one of the most spectacular speculative manias in financial history, and the uncomfortable truth allows for both to exist at the same time. The internet proved real and changed everything, but investors in 2000 still lost $5 trillion betting on it at the wrong valuations. Artificial intelligence may well transform the economy, but 95% of companies investing in it right now see zero return. The leading artificial intelligence company admits it loses money on every premium subscriber, and even OpenAI's chief executive officer warns that people will overinvest and lose money. The question is not whether artificial intelligence represents something real, but whether the valuations make sense, and right now that is a $500 billion question nobody can answer with certainty. What happens next affects your retirement account, your job security, and the broader economy. The next 18 months will reveal whether this boom rests on fundamentals or whether it is a bubble built on hope.